Hello and welcome to the latest Moneymakers Weekly Investment Trust podcast. I'm Jonathan Davis, the editor of the Investment Trust Handbook, and your host for this weekly review of all the latest news and developments affecting the investment trust sector. My thanks to J.P.Morgan Asset Management for agreeing to sponsor the podcast, which as a result will now remain free for the foreseeable future. Moneymakers is an independent research and publishing venture with a mission to explain and inform. But I must remind you that for regulatory reasons, nothing you hear from any speaker today should be regarded as constituting individual investment advice. Having just come back from holiday, I was rather rudely interrupted by reports of that severe market meltdown we had just as I left. But things have settled down since then. Indeed, this week, global equity markets have been in fine form, with the Japanese market bouncing back by 9%, Nasdaq by 5%, the S&P 500 by just under 4%, and the less volatile FTSE All-Share 1.8%, though none has yet regained fully all the losses of 2 weeks ago. Investment trusts performed well in sympathy, with gainers outnumbering losers by 3-1 on the week. Longer-dated gilts edged higher too, although shorter-dated issues moved the other way, while gold continues its standout recent performance, topping the $2,500 an ounce mark this week, and copper was also a notable gainer amongst commodities. This week's in-depth trust profile for subscribers to the Moneymakers Circle features the Edinburgh Investment Trust, along with all the usual features, including tables of the biggest price and discount movements of the week, and a comprehensive roundup of the latest news and results from the investment trust universe, with links through to all the relevant announcements for those wishing to dig deeper. There really is no need to look elsewhere if investment trusts are your thing. I'm joined by Andrew McHattie, the editor of the Investment Trust newsletter, who I think was in the country while all that was going on. And, tell me what happened, first of all, and what's happened since.
Yes, I was on lookout duty while you were away, Jonathan, and we did have this short, sharp shock, didn't we, in the first week of August, and it reminded me very much of the old market adage that stock markets take the stairs up and the elevator down, and it was a sharp drop, actually, that seemed to be triggered by a couple of events overseas. One was some indication of weakness in the US economy, and that news came through at the same time as the Federal Reserve declined to cut its interest rate in August. Those two things combined meant that investors were somewhat worried then about the prospects of a potential US recession. And that happened also to coincide with a surprise rise in interest rates in Japan. That had quite a severe ripple across Japanese markets because it triggered the end, really, of the yen carry trade, and that meant there was a lot of selling, quite dramatic selling of Japanese equities, which dropped by more than 12% overnight, actually, and then bounced by 10% the following day. So we saw a lot of volatility.
Yes, indeed. And the yen carry trade has been around for a long time and is very popular with hedge funds and others. But when that surprise move came, it was only a very tiny fraction of an interest rate increase, but it was enough, I think, to send everybody having to close their positions and everything else. And that led to this dramatic kind of change. We've seen that happen before. Of course, the big question, I guess, is whether there's anything more to it than that. And certainly the market reaction since then suggests that maybe this was something of a kind of technical issue prompted by too many people being on the wrong side of the yen carry trade. But of course, there are some bigger macro issues, but normally one set of data doesn't actually really change the outlook that much, even if it's slightly below expectations. And I guess that's what's happened here. Though, to be fair, I think the equity markets have not fully recovered from that setback yet, have they? They've bounced back, but they haven't got back to where they were.
I think that's a good summary. We've seen quite a good bounce back, actually, in many of the investment trusts that did suffer in the sell-off, but not completely as yet. And whether or not there are future implications to come from this little bout, we'll have to see. But these things do often happen in August when markets are a bit thin. And from reports I've read, I understand that there was not very much volume involved in this, so it could well end up being a blip. But there has been a significant shift in the yen exchange rate, and that could have implications actually for returns from Japanese investment trusts that are traded here in sterling. So I think potentially the headwind of the currency rate could turn into a tailwind there, and that might actually be beneficial. I think potentially here investors would treat this episode as a punctuation mark in the markets which might potentially mark the end of the dominance of the Magnificent Seven and a broadening out towards other growth stocks and more broadly than that across value stocks. So we'll have to see whether this does in fact mark a turning point or whether it was just a small episode that you missed while you were on holiday.
Well, we will indeed find out. Obviously, there's been some interesting developments politically as well. The decision by Joe Biden not to stand for re-election as president and be replaced by Kamala Harris does seem to have changed the odds somewhat in the American election, so that may have some implications for the markets, for the, if you like, the heavy hitters to chew over when they come back from holiday next month. We'll have to see how that one pans out. But meanwhile, there's been quite a few results coming out from the investment trust sector. I should say the investment trust sector was up this week, having been down last week, up around 1.5% so far as we're talking. And there have been some interesting results, so let's kick off with some of those. And let's start off with J.P.Morgan American, which is an interesting trust. It had a change of strategy about 5 years ago, and that change has proved to be very positive, and they've performed very well, have they not?
Well, they have, and this has been a trust, actually, that we've picked for quite some time now, because it's surprising in the American market. There isn't a huge amount of choice, actually, in the investment trust sector. And J.P.Morgan American is very much a mainstream choice, and it's proved a very reliable one over recent years. So this strategy of having effectively a value manager and a growth manager and picking their best picks overall has been working very well for the trust. And its interim results for the first half of 2024 showed continuing outperformance, which has been really quite difficult to achieve in the American market, given the dominance of those Magnificent Seven tech stocks. So here the net asset value total return was 19.1% over the 6 months, which compares to 16.1% from the S&P 500. So that's a really impressive result, actually. And the portfolio was definitely helped by sizable holdings in Meta and Nvidia. But certainly the strategy here is continuing to work. And that's quite important to note because there's been some managerial change here. Actually, both of the lead managers here are retiring. One, Timothy Parton, has already left, and the other, Jonathan Simon, is retiring next year. But JP Morgan have known about this for obviously some time. They put a careful succession plan in place. New managers are in situ. So actually it still looks pretty good. And the managers themselves are reasonably sanguine about the outlook. They certainly do note the possibility of considerable volatility to come around the political noise that is going to erupt in November, of course, with the election. But they see that their portfolio is on a decent valuation discount to the market, and overall they're fairly relaxed about the prospects going forward.
So normally you would think that maybe when senior portfolio managers retire or leave, that's normally a moment to, if you like, pause and consider whether you want to stick with that particular trust if it's done particularly well. But here, as you say, J.P. Morgan have this very well-resourced team around the world, and I guess it's fair to say that they have managed transitions pretty successfully in a number of cases, though, interesting enough, there was a recent portfolio manager change at their European Discovery Trust before the merger, which does suggest that even long-serving managers can be changed if their performance fails to deliver. So very impressive to outperform the US market. Not many actively managed funds can do that. And as you say, there are very few in the investment trust sector, partly because it is so difficult to do that. This trust used to trade at a discount, now trades around par. And it now has a sort of pretty effective discount control policy, I think, where it buys and sells shares within a very tight range around par. So this one, you'd think, would remain a core holding for many people?
Well, I think it would. I think it's done exactly what it was intended to do, and I think people will be very glad actually to have owned it. It's delivered. And I think it's reasonable, as you rightly say, to pause when the managers change, but as there's a well-defined strategy involved here and a good framework for the portfolio construction, I don't really see that that's very likely to change considerably. And particularly in the sector where there isn't a massive choice, unless there's a good reason to change, then I don't think you would. So I think most people will stick with this, and I think it's interesting to look at elements in the trust such as the gearing level, which is about 4% at the moment, which again is indicating that the managers see the outlook as reasonably positive. I don't see any reason to worry about this one.
Yes, I guess the choice here, as so often, is whether you should actually go for a passive fund in the North American market or whether you should try and grind out a few little extra basis points from an actively managed trust. Let's talk about another J.P.Morgan trust and also reported. That was J.P.Morgan Claverhouse, where, again, there may be a management change imminent.
Yeah, same thing applies here, really, that the long-standing manager, William Meaden, is leaving, and now the trust is going to be managed by a trio of managers, Anthony Lynch, Ketan Patel and Callum Abbott. This is very much a planned change. Here, I think there are some hints of a slight shift in strategy, so it's worth talking about. The results, first of all, again for the first 6 months of 2024, showed an NAV total return of 9.2% against 7.4% for the FTSE All-Share. This is a UK equity income trust, and it benefited very much from a holding in another trust we've talked about quite considerably, and that's 3i Group, which has, of course, been doing very, very well. It's also, interestingly, benefited from holding defence stocks. So it's done well recently from Rolls-Royce and Kinetic. And of course, not everyone in this ethical environment will be comfortable holding defence stocks, so that's something to think about. But it's been beneficial for the trust of late. A couple of points I'll pick out here. One is that there was a little bit of commentary around that change of management. There's not going to be too much change of focus here, but potentially I think these younger managers are going to be a little bit more focused on dividend growth prospects, and therefore they might introduce a few more mid-cap names, I think, to the portfolio. So maybe a modest shift, a slight increase in risk there, and perhaps more of an emphasis on future dividend growth rather than the current dividend level. But the current dividend looks fine. It pays a 4.8% yield. And interestingly as well, the gearing has increased a little bit here, just up from 6% to 7%, so nothing dramatic. But nevertheless, I think indicating a decent outlook for the managers. And my feeling with Claverhouse is that it's a pretty decent trust. It doesn't stand out particularly, but of course you don't necessarily want your UK equity income trust to stand out too much. You just want it to keep on delivering decent returns for you. And at the moment where there's a bit more interest developing in the UK, there's no reason why you wouldn't think about this trust.
I suppose that one of the issues around it is the UK equity income sector has been the stalwart of the investment trust sector for many, many years, obviously. And this one has a market cap around 400 million. Is there some question about whether that's the right size? Is that large enough, liquid enough for a trust in such a popular, very competitive sector as we've got here? A lot of the other big names in the UK equity income sector are a lot larger. Do you think that's potentially an issue for this one?
That's a difficult question to answer, actually. Yes, I mean, I think, to me, 400 million still sounds like a decent size, actually. And it's not very obvious, to me anyway, what sort of merger would take place with this one. So I think it's probably fine. And yes, there are many bigger trusts around, but of course you don't necessarily have to be huge in the sector. It's very liquid. And no, my feeling is it's fine, actually. We haven't really seen very much in the way of merger activity in the UK equity income sector yet. That may still be to come. I think we probably do have a bit more merger activity to come in the sector. This isn't really one I'd pick out, though.
Let's move on then and talk about another very popular trust in the equity income space, where this is a global equity income trust, and that's Murray International, where the long-serving manager Bruce Stout has stepped down from the trust. Tell us about this one, their latest results. This has been I suppose you'd call it a slow but steady performer, very much emphasising the dividend return to shareholders.
Yes, I'm going to miss Bruce because I love listening to him and his quite opinionated views on markets, and he certainly stood out and was very happy to give you his quite firm opinions at any moment. But yes, this trust has historically been a good performer, but you have to look back actually quite a long time if you're going to find some good performance stats for it, because over the last 5 years, maybe even over the last 10, it hasn't really quite kept pace with the markets, and that's because it has very much a value tilt. It's not really growth oriented, so it hasn't been investing in these leading tech stocks that have really been driving the market. It doesn't own any of the Magnificent Seven, for example, because of course those are not income stocks. They're not giving you dividends. Well, Microsoft pays a little bit of a dividend, but that's not really what this trust is about. Instead, it's owning a lot of great companies that you will have heard of that have big brands. and they pay good dividends. So companies like Mercedes-Benz, Pernod, Diageo, Cisco, Johnson & Johnson, obviously international stocks, and those have historically done just fine for the trust. It's very much focused on the dividend. It's increased its dividend for 19 consecutive years. I think has every intention of continuing that fine record. The current dividend yield is about 4.6%, so pretty decent. But because of its value focus and the fact that it hasn't been investing very much in tech, it has lagged the market. And that was true in the first half with a net asset value total return of 5.5%, which was really quite well behind the FTSE all-world return of 12.2%. But I don't really mind that in the sense that this is what you're buying here. You're not buying a growth trust, and I'd be a bit surprised if it did outperform at this point. So this is really, I think, for more conservative investors who are not convinced that this AI revolution is going to change the world and that we must all have our portfolios loaded up with tech. I think if you're a bit skeptical about that and you'd like to stick to more traditional investments that are more value-oriented and you're worried about markets, then Murray International is a bit more defensive. And I think if you look at the performance tables, this isn't the one you would buy. You'd buy J.P.Morgan Global Growth and Income in this sector, which is well ahead over 1, 3 and 5 years. But of course, things can change in the markets, and it's quite good to have a balance in your portfolio. So for that reason, I wouldn't be too critical of Murray International at this point, and I wouldn't rule it out for the future.
I think that's very fair. As you said, it was helpful to listen to Bruce Stout. He's been very scathing about the policy of Western governments in particular in loading up in debt and so on, and I dare say one day he will be vindicated by his warnings that that won't end well. But I guess the big difference is that in the last 4 or 5 years, this trust has traded fairly consistently at a discount. In the good old days before that, it used to trade at or around par, sometimes at a premium, and that enabled it to become quite a large trust. It's 1.5 billion or so market cap. I guess there's obviously a succession issue here. They'd been replaced by 2 of his long-standing assistant managers, so it would be very much business as normal, I think, as in the case of the J.P.Morgan Trust we talked about. But can you see this one coming back to par, coming back into favour, or will it take some sort of market crisis for its merits to be perceived in a new light again, perhaps?
Yes, to my mind, that's exactly what's going to happen here. And you're right about the managers, by the way. The succession has been in place for a very long time here. I've met the new managers alongside Bruce, actually, several times now, because they've been working alongside Bruce for a long time. And yes, my sense here is that Murray International is going to continue doing exactly what it says it's going to do, which is, I think, the right thing. And if markets change and value becomes the driver of returns and growth slips out of fashion and those tech stocks stop performing so well, then we'll see Murray International come back into favour and people will love it again. For as long as the tech stocks are really at the forefront of the market and driving returns, then Murray International is going to lag. So it's your choice.
You mentioned JGGI, J.P.Morgan Global Growth and Income, as one of the peer group. I guess the other one, which is not quite as large but similar size, is Scottish American. There's quite an interesting choice in that sector. There's not as many names as there are in the UK equity income sector. So I would have thought there will continue to be demand for that kind of investment approach. I don't know if you'd agree with that.
Yes, I mean, it's nice to have a spread. There are not many trusts in this sector, but those 3 that we've mentioned, Murray International, Scottish American and J.P.Morgan Global Growth and Income, do give you a spread of strategies. And I think that's the right thing. That's what you're looking for as an investor. So you have some choice within that subcategory.
So let's move on now into more specialist areas. There's some interesting developments here. Let's start with JLEN Environmental Assets, which has been around for a long time. We're one of the first trusts to adopt an approach that was geared towards environmentally friendly investments and sort of rode the wave of the ESG wave for a while. But it's been struggling more recently, I think, in terms of performance. Tell us what they had to say this week.
Well, there's something quite interesting about this one now, I think. It's been following the trend that's been prominent of late in the environmental renewable sector, which is that it's been under pressure to sell some assets to reduce its debt. And it has successfully sold actually 51%, so just over half of the assets that it owns in the anaerobic digestion realm. And it's reduced its debt as a result. It's raising about £68 million from the sale here. And it's going to use £20 million of that for buybacks, and it's going to reduce its debt as well. And investors seem to be wanting this. This is what they're demanding from these trusts, that they sell a few assets, reduce the debt, and also prove the NAV. That's the theory. Now, I'm a bit sceptical about that because I think you're not really proving the NAV, even if you're selling your assets at their carrying value. Because, of course, you're not selling the whole portfolio. You're not selling any representative element of your portfolio. You're selling the assets that other people want to buy. And therefore, you're not really proving the NAV of the whole thing. But nevertheless, this is what the market is looking for at the moment. And so this was perceived as good news for JLEN. And the discount has come in slightly. It's still wide at 17.5%. And I think this felt to me like it was a reluctant sale by the managers because they are keeping half of this. So they haven't sold the whole thing. And so my sense is that maybe they didn't really want to do this. So you've got some decent value here in this trust. It's yielding 8.1% still. So I think it's still quite interesting and attractive. But the real element of this deal that struck me, Jonathan, is that they sold these assets to another investment trust, in effect, because they sold the assets to a company called Future Biogas, which is owned by 3i Infrastructure. And I was reminded of this horrible spell in the 1990s with the split capital trusts investing in each other. And I was thinking, well, this kind of circularity is slightly worrying, that if you're trying to get an uplift in value by selling assets, but you're selling them to another investment trust, which is also getting an uplift in value because it's utilising its cash, it just smacks a little bit of sleight of hand to it, and I'm not really sure why there was a good uplift in value here. Anyway, 3i Infrastructure bought these assets, and they do have a bigger cash balance than JLEN, so in a way it does make sense, but you're just shifting assets across the sector. And I think that's something to keep an eye on. It just made me feel a little bit uncomfortable.
Yes, well, I mean, the shades of what is often said was one of the faults of the private equity business generally, is that they can trade assets between themselves without actually adding any real value, but it can help them, or so they say, to demonstrate the value in their portfolio, but they're just shuffling the assets around. Well, it'll be interesting to see whether it turns out to be a better deal for 3i Infrastructure, which has, I think, the better track record, one of the best track records in the infrastructure space, or whether it's, as you say, something of a false step by JLEN. The point about JLEN Environmental Assets, I think, it's been around for quite a long time, one of the first in this space, but it's really suffered from the change in sentiment and the kind of waning of the ESG phenomenon. It's gone from a premium over 20%, which it traded at for most of its early life, to a discount of, as you say, nearly 20%. That's a big shift in sentiment, not uncommon, of course, in our sector, but yeah, it seems to me it's still got quite a lot of work to do to get back into investors' favour. Let's move on then, and let's talk about Biopharma Credit. This is a trust which interests me, I'm afraid. I keep mentioning it because I happen to own it. It's been through a very interesting period. I did sell some at a while for a period and then bought them back again. It's had a big problem with one particular loan, a fantastic track record over many years of lending to the pharmaceutical industry, biotech and pharma companies, but had a big problem with its largest loan, which has only now been finally resolved, I think, after several months of difficulty. So tell us what the latest news from this one is, which appears to be, I'm happy to say, making something of a comeback.
Yes, that's right. So this trust indeed has a splendid track record and was always able to boast that it had never lost money on any loan. It's a specialist in the life sciences sector, loaning money to these developing companies, often backed with their assets. And it does have a great track record, but it ran into trouble with its loan to a company called Lumira DX, and they ran into difficulty. But that situation now has been resolved because the company was taken over. And the good news for Biopharma Credit is that they have recovered 96% of the value of their loan. Now, that's pretty good, actually, and it draws a line under this chapter which was bothering investors and did cast a bit of a cloud over the shares and depressed the rating. So it's good news that this is cleaned up. Of course, it's slightly disappointing for the managers that it's 96% and not 100%, but they're still in with a chance of being able to boast that they've never lost money, because there's a small chunk of this that could still yield a bit more value. There are a few assets in South America that haven't quite been tied up yet, so they might get back all the money in the end. But the point is, now that they have some cash available, they're going to spend another $20 million on buybacks, and they've just announced another new investment here. So it's business as usual for Biopharma Credit. And it is a very interesting high-yielding trust. It's quite difficult to tell you exactly what the dividend yield is here because it's partly based on special dividends which are paid regularly. So the yield is somewhere between, I think, 7.8% on the base dividend that's paid, but more likely in the realm of 10 or 11% once you take into account the special dividends. I think it's an interesting trust, and because it has been under this cloud, the valuation is just a little bit depressed compared to its history. So it could be worth looking at. And I must say, I've got a meeting in my diary with the managers, so I'll be looking into this one a bit further.
Yes, and always these things, there's a currency issue here as well, because most of these loans are in America, in dollars, almost universally, I think. So there tends to be a bit of a divergence. Okay, so let's stick with the healthcare sector, which has been a tricky one for many investors for 2 or 3 years now. Let's talk about, first of all, Bellevue Healthcare, which is one of the larger trusts in the healthcare sector. Tell us what they've had to say.
Another interesting trust, this one, and if you have time to read their monthly fact sheet, you really should, because it's fascinating, actually. It's a beautifully written insight into the sector and the quite idiosyncratic views of the managers and the future of healthcare. But this trust has an annual redemption mechanism, an annual voluntary redemption right for shareholders, and that's coming up, as it does each autumn. I remember talking to you about this last year, Jonathan, and the trust is in the same position again this year as it was a year ago, that it's on a modest discount. It's about 6%, but because shareholders have the right to redeem their shares at NAV, then potentially the trust is looking at a reasonable amount of redemptions, and it's published the timetable here. Now, you need to be a shareholder at the beginning of September to take up this right. But the interesting thing for me is that they've lengthened the period of time between you being able to make the request to redeem and actually getting the money. So the requests have to be in by mid-October, but you don't get the money until the third week of November, which is quite a long time. It's about a 6-week period here. And the board has said that it's extended this period to enable it to complete all of the checks it needs to make under the UK financial sanctions legislation to make sure it can identify the actual owners of the shares. Now, the cynic in me says that's not the real reason. It's really they've extended this period to increase the likelihood that you won't bother with the redemption because you don't really know how much money you're going to get. And it just made me think, actually, about these kind of strategies that trusts are employing here to manage their discounts. And I think sometimes having this hard strategy, this concrete rule that they have to follow about having an annual redemption isn't really very helpful. I don't think it's what the managers want. I don't particularly think it's what the trust want, because, of course, it's all very well giving you the right to come out at NAV, but if you're shrinking the size of the trust, it's not necessarily helpful for liquidity or for costs or for indeed for the future valuation there. So I'm not a big fan of these hard rules that trusts have to apply, and the boards have to offer this to shareholders. Their hands are tied. And my sense is that Bellevue Healthcare are not completely happy about it, which is maybe why they've extended that period. So, yeah, it's an interesting one, and we'll see what the take-up is. But my sense is that on a discount of 6%, there's not much in it, really.
What a terrible cynic you are. I can't imagine that anybody would ever think that way. I mean, shocking, even to contemplate that idea. Well, that's interesting, as you say. I guess you're saying that you would prefer a regime like a conditional tender or something, which is not automatic, but is determined by the performance of the trust, which there are quite a lot of those around at the moment. Would you prefer that as a mechanism?
Well, I do prefer those because circumstances change. And I think we've seen this in many cases, actually, where policies that were obviously very sensible when they were implemented then tie the hands of managers and boards in different circumstances and don't make sense anymore. And we saw that with Biopharma credit for a while, where it had a strict rule where it had to apply money to buybacks because the discount was too wide, and so it was unable to make new investments for quite some time. And it didn't really make any sense at that point in the market cycle. And of course, there are problems as well with conditional offers or discretionary offers, because sometimes boards don't do them when you think they should. And there's no perfect system, but I'm somewhat against these hard and fast rules because I think they're often set up at one period in the market cycle and then they don't make sense when conditions change.
Yes, I think you've got a particularly arbitrary period. It could be at just a particularly difficult point in the cycle or some such. But it certainly concentrates the minds of the managers in any event, whether that's for good or ill, as we shall discuss. And then let's talk next about Syncona, which is another very specialist trust investing in early stage drug development. Has a distinguished history, came out of the Wellcome Trust originally. But again, this one has been struggling in performance terms, is it not?
That's exactly right. If you look back far enough, then you would think Syncona is actually a pretty good, interesting trust. But if you look at the last 5 years, you'll be quite put off, actually, by the performance record, which is not very good. And that continued, actually, recently with the first half NAV total return being quite poor. In the last quarter, actually, the NAV dropped by nearly 5%. But I think, again, you have to look at these figures a bit more deeply and dig into why that's happened. In this case, it was nearly all down to a fall in the share value of one holding in Autolus Therapeutics, which is listed on NASDAQ. And there's been a huge amount of volatility in the share prices of biotechnology and healthcare companies on NASDAQ in the last couple of months, actually. Really enormous daily changes of between sometimes 5 to 10% a day. So the fact that this has gone down, I think, doesn't necessarily worry me too much. And there were a couple of small uplifts elsewhere in the portfolio to balance that a little bit. The Syncona, I think, does need a big win. It needs to get a decent result out of one of its holdings. And potentially, I think, with the prospects for the IPO market improving in the US, and I think maybe more trade sales coming, you never know, it might get a good exit. And in the meantime, unlike many trusts in the sector, Syncona has a very strong balance sheet with cash to spend. So I think there's quite a lot of potential here. And that, I think, is why the discount is so interesting, because the fact that the recent track record is so poor, I think, has really put investors off this trust, which means the discount is actually 32.3% here. And my feeling is that if you are able to be a little bit patient here, then this could make a quite interesting addition to your portfolio if you already hold some other healthcare trusts. It's a bit more speculative than most of the others, I think, but it has potential. And I think it's not going to take too much in the way of good news to really get that discount coming in a bit. It doesn't have to come in all the way for you to do well. It can come into maybe 20% and you've ended up with quite a nice profit.
Yes, it has been an extraordinary sort of switchback ride, this one. I remember when it first came to the market. I mean, the shares went from about £1 to £3 5 years ago, and now they're back at 120. So it has been a real switchback ride. But a lot of that's down to the discount. It was trading at a huge premium for a couple of years. I can't remember exactly how much, but 30-40%. And now it's trading, as you say, on a 30% discount. So it's gone all the way to the depot and back again, as we say. And, well, it's doing good, funding research into drugs to help disease. So one wants it to do well. And I hope you're right about that. I think it deserves to do well, but there's no escaping from the harsh realities of where it is at the moment. Generally, though, I mean, it's interesting that healthcare stocks tend to be pretty cyclical. They tend to do well in certain periods and less well in other periods, and election years are normally one of the periods when they don't do very well. But looking across the whole sector, looking across, International Biotech or Bellevue Healthcare, Syncona, I mean, there's a lot of choice here. They're all very different strategies, again, as you pointed out, some early stage, some later stage. But do you think this whole sector is worth looking at? It has been very depressed for 2 or 3 years.
Well, it has. And I think it's interesting when you look at the presentations from the managers, and I meet them quite regularly, and they all say the same thing to me, that actually the sector is the cheapest it's ever been. If you compare it to the broader US market, and particularly, of course, to the information technology sector, then biotechnology in particular, and healthcare more broadly, is extremely undervalued compared to its history. And at some point, you'd think that's likely to change because, of course, the long-term tailwinds here, I think, are undisputed. That clearly the demographics inevitably mean there's going to be much more demand for healthcare, and I think that's inescapable. And you're quite right that in an election year, there's often quite a lot of focus on drug pricing in particular and the potential for more regulation. But that doesn't really seem to be very much on the agenda with these current presidential candidates. And I'm not sure that will be much of a factor at this point. So I certainly feel that most investors should have healthcare in their portfolio. I think it's one of the central elements that you should have in there. And you have a choice, I think, across the risk spectrum here. As you rightly say, Jonathan, there's a few trusts to choose from. And I think if you just want general exposure, then Worldwide Healthcare is a good choice. But I think you can couple that with some other holdings. You should probably own more than one in this sector. And there are those sort of middle-ranking trusts like Biotech Growth and International Biotechnology, which are obviously focused particularly on biotech, but really across the capitalization spectrum. And then you have the small specialist ones that are much more punchy. Syncona and RTW Biotech are the obvious ones there. So I think some combination of those trusts is quite a good way forward. In my newsletter, I've recommended for some time owning Worldwide Healthcare and RTW. But I think actually if you look at the ratings across the sector, there's some quite decent value there at the moment. And yeah, I think worth picking some up if you don't own them already.
Finally then, as we complete this sort of survey of recent announcements, tell us what's been happening at Riverstone Credit Opportunities. This is a debt fund which is managed by the same people who manage the Riverstone Energy Trust, which is an interesting vehicle as well, worth looking at, I think. But tell us about this one.
Yes, the reason for mentioning this one is not really because many people listening to this podcast will own it. It's a pretty specialist trust, but it's really to talk about more generally what's happening here with the sector. So this is a credit trust that is basically too small to continue. It's actually a perfectly good trust, but it's just too small, so it is winding up. And of course, because it's a credit trust, it can't immediately liquidate its positions. It has to wait for loans to mature. But it is now returning 25% of its capital to shareholders through a compulsory redemption of shares in September. But the mechanism here means that there should be an uplift because the shares are trading around 82, 83 US cents. And 25% of your shares are being redeemed at the net asset value, which is just over $1. It's actually $1 and 1.7 cents. So you should get an uplift in value there. And I've noticed actually that this has been the trend for quite a few of these trusts that are returning capital piecemeal. They're doing it bit by bit. And it does tend to work out reasonably well for investors. I've had a couple of trusts that I've been following, such as GCP Asset-Backed Income, where you've had this partial redemption and you get a decent uplift from it. And really, it pays to be patient, I think, if you're a shareholder in these cases. In this particular case, with the Riverstone Credit Opportunities Trust, there's a slight wrinkle in that it has a holding in a loan which is made to Harland and Wolff, the shipbuilder, which has been in the news recently because it's in financial difficulty. And that is rather muddying the waters here. But nevertheless, I think you'll probably still see a decent uplift here. And this is part of the continuing trend we've seen where money is flowing back to shareholders from redemptions and winding ups and reconstructions and things that were decided a few months ago. And I'm hoping that when this money comes back, it will stay in the sector and be reinvested into other trusts.
It may be worth mentioning, just in that general theme, what's happened at Riverstone Energy, which was rather controversial for a while because it issued shares at a discount, I think, as I recall. Became unpopular, but that's delivered some very good returns as it's been shrinking itself over the last few years, and you could have made 100% over the last 5 years from that one. So you're right. I guess the issue with these debt funds, though, is that it's a good process, but it does take some time, and there could be a long tail of the final bits to get rid of. We've had warnings about that from one or two other debt funds that have been wound up, have we not?
Well, we have, and one that springs to mind is Blackstone Global Loan Financing, which I own actually. I think it's a really good trust. I'm disappointed it's winding up, but it has said it may take 7 years actually for it to liquidate all of its assets. So I think, again, it's quite a long period. A lot can happen in that time. And there's an opportunity cost to you of being patient and holding on and waiting for those returns, isn't there? So in part, it depends on whether these trusts continue to pay their dividends during this period, which Blackstone is doing and GCP Asset-Backed Income is doing. So I don't mind then if I can be as patient as they need me to be if I'm still getting paid a very nice dividend yield to wait. But nevertheless, there are circumstances where it wouldn't necessarily pay to wait. But I think on the whole, actually, it's working out largely as planned. There's a good reason for these trusts winding up, and when they're paying back the value, usually it's at a higher asset value than the prevailing share price. So, yeah, I still think on balance it's worth being patient with these things.
Okay, so that was Andrew McHattie, the editor of the Investment Trust newsletter, talking to me this week about the recent market squall and some of the names in the investment trust sector that have been reporting or making important announcements. We'll be back next week as normal and looking forward to getting back into the swing of podcast after our summer break.
Thank you for listening. The Moneymakers Weekly Investment Trust podcast is independently produced and edited and is listed on all leading podcast channels. You can also sign up at the website money-makers.co to be notified every time a new podcast is available. Please note these podcasts are provided for educational purposes only, and nothing you have heard from any of the speakers should be regarded as constituting investment advice. If you want more news, analysis, interviews and other investment trust content, don't forget to look at the Moneymakers Circle, available now for a modest subscription at the website.